The headlines have been dominated by falling commodity prices, due in part to a slowdown in China. Let's get an inside look at what's happening in Asia. Joining me is Anthony Cragg, portfolio manager at Wells Fargo Advantage Funds. Nice to see you here in the States.
Good to talk to you again.
Now, you manage the Emerging Markets Equity Income Fund. You've got a lot of expertise in China. So look, tell us from being there on the inside, is this slowdown as bad as everyone is talking about?
Well, the economy in China is slowing, there's no question about that. We would argue that was an inevitable event, that it could not conceivably go on, the second biggest economy in the world, couldn't go on growing at the same rate it was for much longer. So that slowdown is something I think not just China has to get used to, but the rest of the world has to get used to. And honestly, I think the negative effects on China are overstated. Even the negative performance effects on stock price performance. If you read the papers, you know, without focusing too much, I'm sure most people would think that China had hugely underperformed the rest of the world. In fact, that's not true at all. It's been one of the best performing markets, even now, even after this correction. Last night, for example, as of last night, year to date, the Shanghai Composite A-share market was down just over 8% year to date. The Dow is down more than 10%.
Yes,
so,
we're aware of that here.
I think that's very, contrary to people's perception of China, where they think it's all been death and disaster. But there is definitely an economic slowdown. I think that's inevitable, and I think that's the new reality.
So that, in turn, brings us to the emerging markets overall. Now, the other story that's been big is the collapse in commodity prices, really. And so a lot of these emerging market countries are impacted. What do you see in terms of that either stabilizing, and do you in general avoid any of the commodity-based companies in your own portfolio?
Well, Rhonda, I think it all argues for selectivity between countries. To lump all emerging markets together never really made much sense, and particularly doesn't now, given oil and commodity prices at this level. Why doesn't it make sense? Very simply because some emerging economies produce those and some consume them. So obviously low prices is bad for the producers, like Russia and Brazil, and basically good for the consumers. So, you can't really say low commodities is bad for all emerging markets. It's bad for the producers, certainly. But you remember, some of these big economies like India, like China, most of Asia, are net importers, particularly of energy, oil, but of other commodities as well.
Does that mean you continue to like China, and do you like India?
We do. We prefer Asia as a whole, as a region, partly because it is a consumer of power and commodities rather than a producer. For other reasons as well, we see it as more politically stable. If you look at what's going on at the moment in Russia and Brazil, you have a lot of corruption scandals, a lot of political turbulence, which thankfully we're relatively immune from in Asia.
Within individual sectors, you are heavily weighted in financials and industrials. Now, let's talk about financials. What is it in that sector that you like? Is it a play on the consumer? What happens when interest rates start to rise in the U.S.?
Well, financials and industrials as labels are actually slightly misleading, only because financials include property, and we do like property in a number of these places. In China, for example, property take-up is still pretty strong. The real end-user demand is still healthy in China because of rising wages over the last few years, while supply has actually contracted because in the slowdown, economic slowdown, developers have been more reticent about embarking on big projects. So you have quite a good supply demand situation, a little bit like the US, where after the 08 here, property companies pulled back their horns a bit, but demand has now picked up again. So we like property among the financials. Some of the banks we think are attractively valued. On industrials can be misleading because it includes, for example, things like environmental companies. So in China specifically, we think environmental is a big theme. That's one we've been playing for a number of years, and if you go to China, you realize the urgency of addressing the air pollution, water pollution, and so on. So that's a big investment opportunity. Another one I think is a rather particular theme, but it was a concept introduced 2 years ago by Xi Jinping, which is called One Belt, One Road, which is the expansion of Chinese economic and infrastructure development, not only across China, like the old Silk Road, but into the region and into other countries through what is now called the Maritime Silk Road, so overseas. So if a Silk Road could go over water, that's what it would be. So I think there are a number of themes: environmental, infrastructure we still like. We think another important event coming up is the inclusion of the ADRs, Chinese ADRs, in the MSCI, which is happening in November.
Something to watch and some interesting ideas. Anthony Cragg, good to see you again.
Thank you, Rhonda.
I'm Rhonda Schaffler for The Street.